Top 10 Financial Questions in Canada. How do I buy my first home in Canada? Buying your first home in Canada can be a big step, but there are programs and tools to help. You can start by opening a first home savings account, also known as an FHSA, or use the RRSP Home Buyers Plan. Make sure to evaluate your financial health and aim for a credit score of at least 620, though 680 or more will get you better rates and more options. And don't forget to save for a down payment, 5% of the first $500,000 and 10% for anything above that. A strong financial foundation is key to making your home ownership journey smoother. Once your finances are in order, it's time to take action. Find a qualified realtor who understands your needs and the local market. Begin house hunting with a clear sense of your budget and goals. You should also check your credit score. Tools like Borrowell or Credit Karma can help. For most lenders, a score of at least 650 is recommended for mortgage approval. Then, get pre-approved for a mortgage to know exactly what you can afford before you make an offer. Once you've found the right home, you'll need to make an offer and secure final mortgage financing. It's important to conduct a professional home inspection to identify any issues. Then comes the closing process. Don't forget key tasks like setting up home insurance, notifying the Canada Revenue Agency and your bank about your new address, and connecting your utilities. Buying a home in Canada is not just a financial decision, but a process that requires attention to detail at every step. Should I choose an RRSP or a TFSA? One of the most common financial questions Canadians ask is whether to invest in an RRSP or a TFSA. Each account has different advantages depending on your income level and goals. An RRSP, or a Registered Retirement Savings Plan, offers tax-deductible contributions, meaning you can reduce your taxable income now and pay taxes later when you withdraw. A TFSA, or tax-free savings account, allows your investments to grow tax-free, and withdrawals are not taxed at all. A quick rule of thumb: use an RRSP when your income is higher now than it will be in retirement, and a TFSA when you want flexibility or expect your income to grow in the future. Choosing the right one helps you maximize your savings and tax efficiency. What's the best high-interest savings account in Canada? If you want your money to grow without investing in the stock market, a high-interest savings account is a smart option. Top choices in Canada include Simply Financial's high-interest savings account, Scotiabank's Momentum Plus, EQ Bank's personal or notice savings accounts, and Manulife Bank's Advantage or TFSA accounts. Each account offers different benefits. Some focus on higher interest rates, while others reward consistent saving. Compare features like interest rates, fees, and ease of access to find what works best for you. How can I improve my credit score in Canada? Improving your credit score is one of the best things you can do for your financial health. Start by checking your credit reports for errors. Even small mistakes can hurt your score. Make it a priority to pay all your bills on time. Keep your credit card balances low, ideally below 30% of your credit limit. And don't cancel your oldest credit card. Even if you don't use it often, the length of your credit history matters. These habits build a stronger, more reliable credit profile over time. To go further, diversify your credit. Lenders like to see that you can handle different types of credit, such as a credit card, a car loan, or a student loan. If you're new to credit or trying to rebuild, consider using a secured credit card or a credit builder loan. Avoid applying for too many new accounts at once. Each application can temporarily lower your score. Finally, monitor your credit progress regularly to stay on track and celebrate improvements along the way. A good credit score opens the door to better rates, approvals, and financial confidence. Should I rent or buy a home? This question depends on your current financial situation and long-term goals. Buying a home makes sense if you can comfortably afford the mortgage, property taxes, and maintenance costs. It's also ideal if you have a stable income and plan to stay in the same place for 5 years or more. On the other hand, renting offers more flexibility. It might be the right choice if you're still saving for a down payment, want to avoid the stress of home ownership, or expect to move for work, education, or lifestyle reasons. Ultimately, there's no one-size-fits-all answer. Choose what aligns best with your life stage and financial plan. How can I get out of credit card or personal loan debt in Canada? If you're struggling with debt, there are smart strategies to regain control. Start by choosing the right type of investment account, such as a TFSA, FHSA, or RRSP, depending on your goals and tax situation. Decide how much you can afford to contribute regularly, even if it's a small amount. Use beginner-friendly platforms like WealthShare Invest, WealthShare Trade, Quest Trade, Coho, or TD Easy Trade. Each platform offers tools to help you invest with low effort and low cost. Building an investment habit, even while paying off debt, can create a path toward long-term financial stability. How do I start investing with little money in Canada? You don't need a large amount to begin investing, just the right tools and mindset. Start by opening a TFSA or RRSP. Choose an investment platform that fits your needs and comfort level. Learn as you go. There are countless resources to help you understand the basics. You can invest in ETFs, robo-advisors, or even mutual funds through your bank. Set up automatic contributions to stay consistent. Even small steps taken regularly can lead to significant growth over time. Am I saving enough for retirement? It's never too early or too late to ask this question. Most people will need between 60 and 80% of their pre-retirement income each year in retirement. You'll likely rely on a mix of income sources, such as the Canada Pension Plan, old age security, personal savings, and potentially a workplace pension. To find out if you're on track, use tools like the Government of Canada Retirement Income Calculator or Tangerine's Retirement Calculator. If you're behind, don't panic. Increase your RRSP or TFSA contributions, consider delaying CPP, and look for areas where you can reduce expenses. Knowing your target and taking action early can make a big difference in your retirement comfort. What tax credits or benefits can I claim? Canada offers a variety of tax credits and government benefits to support individuals and families. There are general credits available to most people, like the GST/HST credit, the Climate Action Incentive Payment, or the Canada Workers Benefit. Seniors and retirees may be eligible for additional benefits such as the Age Credit, Pension Income Credit, or Guaranteed Income Supplement. To get the most out of the system, make sure you file your taxes on time, use CRA's benefit calculators, and review your eligibility every year. These credits can significantly reduce your tax bill and increase your available income. How do I afford the rising cost of living in Canada? Rising prices can feel overwhelming, but there are strategies to stay ahead. Start by cutting key monthly expenses like groceries, housing, and utilities. Use budgeting apps such as Mint, PocketSmith, or Coho to track where your money goes. Find ways to increase your income through a side hustle, selling unused items, or applying for government programs. Save automatically when possible, and claim all available benefits like the GST/HST credit, Canada Dental Benefit, or Canada Child Benefit. Try budgeting with the 50-30-20 rule, 50% for needs, 30% for wants, and 20% for savings. A little structure can go a long way toward restoring control over your finances. Thank you for watching. Don't forget to subscribe to our channel, Prostobank TV, for more practical advice on finance and economics in Canada. Visit our YouTube page to explore more videos that make money matters simple and clear.